Good day, everyone. Today's topic is manufacturing overhead. Now, before we go further, we need to know that manufacturing overhead is one of the elements of production, which are direct material, direct labor, and manufacturing overhead. And manufacturing overhead is an account created for all the indirect costs in the factory. You know, for example, your indirect labor, your indirect material, your factory insurance, your factory maintenance, your factory depreciation, all the costs that are not direct labor and direct material, they fall under this account of called manufacturing overheads. Okay, let's go to the next slide. Right. As I've said, that manufacturing overhead is one element out of the three elements of production, which is direct cost, direct cost, which is direct material, direct labor, and manufacturing overhead. Let's just hear what they say here. Okay, so manufacturing overheads is the third element of production cost. Okay, so they include all indirect costs involved in the production of a final product. That means manufacturing overhead includes all the indirect costs in the factory. So here the key word is factory or manufacturing. So um, so any cost associated with a factory or manufacturing is a production cost, right? If a cost in the factory is not direct material or direct labor, then it is manufacturing overheads, right? So another caution uh, is that we should not confuse manufacturing overheads with manufacturing costs. Okay, so manufacturing costs are not manufacturing overheads. Manufacturing costs are direct production costs. In other words, they are direct material, direct labor, and manufacturing overheads. Manufacturing overheads is another thing. Okay, it's not manufacturing or production cost. So manufacturing overheads are also referred to as factory overheads or production overheads. So the distinguishing factor here is overhead and cost. If you are talking about production overheads, you are talking about manufacturing overheads. If you are talking about manufacturing costs, that means you are talking about production costs. So your manufacturing costs are the same as your production costs, okay? Because these are costs. Another word for production is manufacturing. So if you say production cost, is the same as saying manufacturing cost. Right. That was just an introduction. Now another thing that we need to know is that manufacturing overheads are divided into fixed part and the variable part. So a fixed part is those manufacturing overheads that do not change. They do not vary according to how many units are produced. They stay the same. Okay, for instance, in a factory, insurance, factory insurance, the company pays the same amount every month. If it's 10,000, it's 10,000 every month. It doesn't change whether we produce 1 unit or we produce 2 million units. Also rent is fixed. Whether we don't produce that month or we produce 3 million or 500,000, whatever number, it does not matter. We still pay the same rent every month. right? So let's see. So these are the fixed manufacturing overheads. These are overheads which are fixed and do not change, right? They remain constant or the same no matter what the level of production is. Okay. For example, if a factory rent is 10,000 per month, it does not matter whether the company produces or produced 1 or 20 or 3,000 units, etc. It still pays that 10,000 rand per month, right? Now, how do you display graphically the how do you show your fixed manufacturing overheads graphically? Okay, so you have your y-axis and your x-axis, and then you have your cost in terms of rands, and you have your quantity in terms of units. So your fixed your fixed curve will always be like this. So if rent is 10,000 for instance, so we know our fixed cost is rent, which is 10,000 per month. So we'll be paying for 10,000 whether we produce 1,000 or 2,000 units or 3,000 units, we still pay the same rent. Right, I hope that is clear. Now let's go to another one, which is variable manufacturing overheads. Let's go to the next slide. Okay, let's continue with the first one. So they say, as you can notice, the fixed cost line, if you look at that diagram that we have just presented now, the fixed cost line is a straight line parallel to the x-axis. Okay, it indicates that the amount that is 10,000 does not change, whereas the quantities produced change from 1,000, 2,000 to 3,000 to 4,000 and lastly to 5,000 units produced. So those fixed manufacturing overheads, they stay the same no matter how much quantities are produced. Right? Okay, let's go to the next slide. Now we are done with fixed manufacturing overheads. Let's go to variable manufacturing overheads. So these overheads are variable. Anything that is variable, it means that it can change. It changes from time to time. All right. So your variable manufacturing overheads, these are overheads which vary or change in direct proportion to the number of units produced. Right. The variable cost line shows how variable costs increase as the number of units increase. Right. Let's say, for instance, if a variable cost of 500 rands, when you look at the graph, we incur these costs when we produce 1,000 units, and then we incur 1,000 rand variable cost when we produce 2,000. We incur 1,500 rand cost when we produce 3,000 units, and so on and so on. The more you produce, the more you pay for variable cost. All right, so this is how you show it graphically. This is a graphical representation of your variable manufacturing overheads. It starts here from 0, meaning if you don't produce, you produce 0. That means there's no variable cost that you are going to incur. So if you produce 1 unit, that means you have to pay also some kind of a variable cost, right? So this is how you show it graphically, right? Okay, let's go to the next slide. So now we go to semi-fixed. Remember we talked about fixed manufacturing overhead. Now we're talking about semi-fixed manufacturing overhead. That means when something is semi, it means it's not full. All right, it's not full. So these are overheads which have a fixed and a variable component in it. Okay, so we have a fixed component and a variable component. So it is fixed for a certain period and then changes to another level, then remains fixed at the new level. Okay, let's take for instance the example of a rent. A rent is fixed. Every month you pay for rent, say 2,000 rand for 2 rooms. 2,000 rand. You pay that every month, 2,000 rand, 2,000 rand. So maybe after 3 years, the landlord says, now we're increasing the rent to 3,000. So that's what they mean when they say it's a semi-fixed. It's fixed for a certain period, and then it changes, it increases to another level. Okay, like this is how you show it graphically. This is a graphical representation of a semi-fixed manufacturing overhead. So let's take that example of a rent. In a factory, we pay 10,000 every month for rent. 10,000. We paid. At some stage, the rent changes. It increases. Okay, it increases to 14,000. You see? So it's fixed, and then at some point it changes. Okay, and then it increases to 14,000 according to our example. All right, I hope that one is clear. Let's go to the semi-variable manufacturing overhead. Remember, we have fixed manufacturing overhead, we have variable manufacturing overhead. We also have semi-fixed manufacturing overhead, and now we're talking about semi-variable manufacturing overheads. Right. So with this one, just as in semi-fixed manufacturing overhead, semi-variable manufacturing overhead have a fixed and a variable component. For example, a factory telephone, there is a monthly rental part of it which is fixed, whether the telephone has been used or not. Also, there's a variable component which depends on how much has the telephone been used, right? So if you take an example of your cell phone, and say you open an account for a cell phone, a contract from MTN, let's say, right? There'll be that money, that fixed amount of money that you pay every month. Let's say it's 350 rand. You pay that 350 rand. That is a fixed part of it. Okay, you pay it, it does not change every month. Also, there's that variable part of it whereby you use the airtime, and then every month you pay for that airtime. And that airtime is not always the same every month. 1 month you can pay maybe 100 rand, depends on how much you have used the phone. The other month can be more than that. Let's say 850. So that's a variable part of it. Okay, I hope that example is so clear. Okay, let's go to the next slide. This is how you show your graphical representation of a semi-variable. Sorry, this was supposed to semi-variable. Remember, the semi-fixed one is the one that goes from here and then it goes like a Z. So this one is supposed to be SVMO, semi-variable manufacturing overhead. So with this one, you will have the fixed part. Remember the fixed one. and then you'll have the variable part, which will start from here, from the fixed one. You have the variable part. This is your semi-variable manufacturing overhead when you show it graphically. Okay, let's go to the next slide. Now we go to budgeted manufacturing overhead. Budgeted manufacturing overhead. I'm sure everyone will agree that the term budget it goes in line with planning, right? When you say you are budgeting, it means you are planning something. Okay, so these are budgeted manufacturing overhead. That means these are overheads that were planned, the company has planned to pay for a certain period. Okay, for instance, management might say in our plan, in their planning, they might say um, every month manufacturing overheads that we should pay should be 3,000 rand. You see, that's a planning. It doesn't mean actually it's gonna be 3,000. It can be more, it can be less. Right, let's go to the following slide. Okay, here they say, remember there are three elements or components of production cost, which is for production to be complete, it must have three components, which is direct material, direct labor, and manufacturing overhead. And you must also remember manufacturing overhead are divided into fixed overheads and variable overheads. Okay. Now, direct material and direct labor are direct production costs. So manufacturing overheads, however, are indirect costs, right? Are made of many amounts such as factory rent, factory electricity, factory security guard wages, factory depreciation, indirect material, indirect labor, and any other cost that is related to the factory, apart from direct material and direct labor. So any cost in the factory which is not direct material and direct labor is an indirect cost. It falls under the account of manufacturing overheads. Okay. Now, remember that was budgeted manufacturing overhead. So we have actual manufacturing overhead, right? Actual is simple English. Actual when something actually happens. Okay, you plan, but your planning might not be the same as your actual action, right? So on these overheads, so these overheads are only known or determined at the end of the year, right? So you can plan, but you are not able to know actually how much you are going to pay for the manufacturing overhead. Okay, management can budget the overheads and say for this year we must spend 200,000 for overheads, but actually we are going to see at the end of the year or at the end of the period how much we actually spent. Okay, we can't predict. Prediction is done in planning, in budgeting. Okay, so actual overheads are only known or determined at the end of the year. They are recorded in the journals and then posted to the ledger. Okay, fine. Let's go to the next. Remember, we're talking about actual manufacturing overhead. Let's go to the next slide. Okay, applied manufacturing overhead. Applied manufacturing overhead. Right. Applied or allocated, they can use a lot of words. Applied manufacturing overhead or absorbed or allocated or recovered. So don't be confused. If they use these terms, don't be confused. You must know it's the same thing, right? So applied, remember we had three manufacturing overheads here. We have budgeted overheads. Okay. we have we have budgeted overheads, we have actual overheads, okay, actual, and we have absorbed or allocated or recovered. Let me write OR for recovered. So this recovered is also stands for applied, for absorbed, for allocated. Okay. So we said this one is during planning, is budgeted. Um, let's say management plans that we are going to pay 110,000 for this year for manufacturing overheads. So this is planning, okay? And then the year goes on and goes on and goes on. We keep on paying for every month for manufacturing overheads, and then at some particular time, we 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 realize that so far we have paid 90,000 rands for the overheads. Okay, at some particular time. And then the actual overheads are the ones that we will know at the end of the year. How much was the actual overheads? Right. Okay, let's hear what they say here. Okay, applied overheads are calculated to see which part of the manufacturing overheads has already been allocated to the production process. Okay, right. They are also called absorbed or allocated or recovered manufacturing overhead. So the question is, which manufacturing overheads are part of the production cost? Is it budgeted? Is it actual, or is it applied? The answer is applied. So whenever you talk about overheads, or you do calculations about overheads, the ones that you include in your production is the applied ones, not the budgeted ones, not the actual ones. Okay, you'll see when we do calculations. So from now on, you would say that the three elements of production cost is direct labor, direct material, and applied manufacturing overhead. Applied manufacturing overhead. So to recap, budgeted manufacturing overhead are known at the beginning of the year because it's planning, while actual manufacturing overhead are known only at the end of the year. And then applied manufacturing overhead are what we are now going to calculate. Right. Okay, don't forget we have budgeted manufacturing overhead, that is planning. We have actual that we know at the end of the period. The budgeted we know at the beginning because it's planning, and the applied or recovered or allocated are the overheads that are already applied or paid for. Okay. Right. Let's go to the next slide. Nonsense, the computer is another avenue. All right. Now here they are explaining what I've just explained. The budgeted overheads and budgeted bases will be given to you in the question. You use your budgeted overheads and your budgeted bases when you calculate your predetermined rate. Your predetermined rate. Okay. So if the budgeted basis is a cost, that means your basis will be your direct labor cost or your direct material cost or any cost. As long as it is a cost, then you would multiply the above formula by 100 and express your answer as a percentage. Right. Then note the answer to all other bases must be expressed in rands. As long as the basis is not a cost, then the answer must be in rands. But if the basis is a cost, then your answer must be expressed as a percentage. I hope that was clear. Okay, let's go to the next slide. Okay, now let's say you've calculated your predetermined rate, your predetermined freeze here. Ay, 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 ay. Okay, let's say you've calculated in step one, you calculated your predetermined rate, and then let's say and then your answer, let's say your answer was 20%. Okay, that's your predetermined overhead rate, 20%. Now, since you've got your predetermined rate, now you need to calculate your applied overhead. Okay, so step two, calculate the applied manufacturing overhead, because you do have the rate now, and also they told you which basis you must use. start by bringing down your answer from step 1, which is 20%. Remember to include the basis in your answer. Okay, so let's say your basis is direct material cost or direct labor cost. So let's say they say to calculate applied overhead, or applied overhead is 20% of the direct labor cost, and say total direct labor cost, let's say is, for example, let's say it is 100, and let's say it is 120,000 rand. 120,000 rand. That's your basis, okay? That's your basis, which is direct labor. So they say applied overhead, or overheads are applied at 20% of direct labor cost. And how much is direct labor cost? It's 120. So that simply means you are going to take 20% of 120. 20% of 120, which equal to say 10% of this is 12,000 times 2, 24,000. So which is 24,000. 24,000 is your applied overhead, or recovered overhead, or allocated overhead, whichever term they use. Right. And then, okay. Right. Okay. Hope that was clear. I hope that was clear. Let's wrap it off. Okay, let's go to the next slide. Let's go to the next slide. Right, let's see what they say here. Okay, bring down the, okay, they're still doing the same example that we were doing. Bring down the answer from step 1, which is that percentage 20%. Substitute actual company information, that is your basis. You take that percentage you calculated, that predetermined, you multiply by the basis that you were told to use. In this case is direct material cost. Multiply it, and then there you have your applied overhead. Okay, therefore the applied overhead for the company are 132 rand. Right. Okay, let's go to the next slide. Right. Okay. Okay, actual manufacturing overheads. Remember, firstly, we spoke about actual overheads, applied overheads, and budgeted overheads. Now we're talking about the actual overheads. Actual overheads are recorded as they okay, and the total will be known only at the end of the year, right? For instance, depreciation, factory depreciation. A factory depreciation is a manufacturing overhead. So we have these 3 methods of depreciation. I think we know 2 by now. The cost price or straight line or fixed method, whereby depreciation is based on the cost price of the asset, and then your formula will be your cost price multiplied by the depreciation rate multiplied by the period or time. Okay, the second one, then the second one is the diminishing balance method. Here depreciation is based on the book value or the carrying value of the asset. Right, the formula, you take your cost, your initial cost, you minus your accumulated depreciation multiplied by the rate multiplied by the period. Okay, and then the last one, the last method of calculating depreciation is production units method. Okay, so here depreciation is based on the number of units produced during a financial period. What is the formula? You take the units produced during the current financial year, you divide them by the cost price, which is multiplied by the budgeted units produced during the economic life of the asset. Actually, these are the questions that they don't normally ask you, even if you can go through the previous year's question papers. But it is very important for you to know this information just in case. Okay. All right, let's go to the next slide. Go to the next slide. Right. The recovery of manufacturing overheads. Now, guys, in this section we are going to compare the actual overheads and the applied overheads. Right. Let's take a simple example. Let's say someone you borrow someone money. You borrow someone 10 rands. Okay. So how much does that person have to give you back in payment? That person has to give you 10 rand back, isn't it? That's the actual amount that you're supposed to get. Right? However, if that person pays you 7 rands, it means that the amount that the person has applied or has paid you is 7 rand, which is less than the money that you're supposed to get actually. It's less than by 3 rand. And what do we call that difference, that variance? We call it a variance. So if it's less than the actual, we call is under applied or under allocated or under absorbed. However, let's do the vice versa version of it. If this person I borrowed 10 rands and then actually has to give me 10 rand back at the end of the period, but this person at the end of a period gives me 15 rands, that means that person has overpaid me by 5 rand. He has over applied instead of actually paying me 10 rands. So this is the section we are going to talk about over application and under application, whereby we compare actual and applied. So this is the calculation of an over applied or under applied overheads, which is step 3. So calculation over applied or under applied overheads, we compare the actual overheads to the applied overheads. The difference between the actual and the applied overheads is the over or the under applied overheads, right? So it depends. It depends whether we over applied or under applied. So what is over recovery or over allocation or over applied? It's when applied overheads are greater than actual overheads. That means we have paid more than we actually have to pay. So we have over applied, or in simple English we can say you have overpaid. Okay, then okay, let's say if according to this example, if a factory telephone, for example, has actually cost us 20,000 for the year, that's an actual cost, but we have already applied or paid 28,000 for this overhead, then this means we have over applied or overpaid by 8,000. Is that clear? Okay, next slide, which is the last one. And that's the end of it, guys. So please listen to this video, and whoever belongs in my class can WhatsApp me using the WhatsApp group chat and try to get clarity, or come to see me. Thank you very much, and bye.